Thank you, Brad. So if you see me nervous right now, this will vanish, but it is because I'm afraid of getting into wrestling with Brad, because it's so much that I wanted to talk today. So yes, I'm German, and what justifies me to standing here in front and talking about the US economy and real estate markets? Let's start with this. My father spent a great part of his working life into the US. He's a combat pilot, and he was trained in Phoenix, Arizona. So I will share two things I inherited from him with you today. This is my missing British accent, and the other thing is that we need a flight altitude of 10,000 square feet to cover this topic in 20 minutes. Let me get familiar with the technique. So, yes, Brad, you asked me about two slides about the US economy. The US economy is in a high flight. So if you look at the first growth graph, the GDP growth will peak this year. This is data from Oxford Economic. We could talk long now why is that, how it is. It is about the consumption, very strong, will grow by 3.5%, but it is also for business investment starting, so we see sentiment changing. For me, economics is 50% the hard data, what's happening now, 50% what people think will happen. So actually, people are optimistic. Consumption will rise, and the productivity that was laggard in the US for the last years will now grow by 1.3%. That's the best data you have in the last decade. Ended on a strong note, will continue strongly, maybe even 3%, who knows. But there is a but, and you read all the newspaper. I read the FT in the morning. I was very eased and relaxed seeing that Trump maybe will not be so hard on the Trump trade, on the tariffs, on aluminum and steel we all know about. So what are the buts? There are protectionism. We have full employment, 4.1%, 17 years low unemployment in the US. That means full employment. We will see in some metros it's difficult to find the talents you need. So actually this is a little bit hindering on growth. And if you look at office employment, we again using Oxford Economics data, you see that the big growth rates from 2.5% the last years are going down. Still positive, but 0.5. This had also demographic reasons. You all know that the baby boomers are going to retire. Capital markets, we heard about it, Scott. There had been a volatility in the first week of February. You all remember what happened with the S&P. During the week, we had a 10% correction in the stock. But I think that this is a general sign that sentiment is shifting from secular stagnation towards reflation. These are reflationary breakouts you see right now. Fed is tightening. Optimism is in the economy. You're hearing presidents of the Fed, the one in New York, who is talking about overheating. Again, 50% is sentiment. If you just start to talk about overheating, then inflation could go up, and you know all what that means. US inflation here, this is consensus a little bit. We will touch the Fed rate for 2% this year, core inflation 1.8%. And if you look at the big question, what will the rates do? You see that this is what Scott also said. Now I can confirm that there seems to be a little bit the border of the 3% in the 10-year government yield, and we have to see if that can be exceeded. Let me make the summary of my summary. What is the economy doing? I think we have very strong fundamentals. On the negative side, the elevated asset valuations, yes, the central bank fueled equity in the markets, liquidity in the market, and we have an equity boom, and there's some nervousness. It is normal. I went through two cycles, so it's normal that in the stage of the cycle where we are right now, there starts volatility, and we will see that actually. Even yesterday, when it was announced that Gary Cohn, the advisor of Trump, was just dismissing, you saw movements on the stock. So nervousness is there. Political uncertainty, yes, and potential growth exhaustion in 2019, which apparently is still the consensus between the economics. On the positive side, healthy employment numbers for February out, 235,000 jobs again. So we have solid consumer spending and strengthening business investment. For me, for sustainable growth, is that what you need? So you don't need to have buybacks and investments in ETFs would bring more nervousness to the stocks, but you have to invest in order to get sustainable growth. What's very important is that some metros are doing better than others in the US. So room to run, but volatility ahead would be my title for the economy part. transaction volumes, I will skip on that one. We heard about, I see it the same. So here maybe we talked about the differences in the sectors. Volume is slightly down, 7%. That's a modest decline, but you see increases in logistics. So the Oscar goes to logistics clearly this year, but also the last years with rental growth of 5% over the last years and more to see. Retail a little bit suffering, minus 20%, and office also down. But the interesting thing are the selectiveness you have between and in these sectors. So you have suburban offices, and we talked about it, you discussed it before, suburban offices with record highs in the office. So there is negative general, but positive increases. In retail, you see 19% increase on convenience space and grocery anchored retail, which is safe, and you see a 9% increase on single tenant assets. We talked about the cap rates, and we talked also about the spreads. They're still sufficient, and the question was very interesting. We can discuss that further, how the treasury yields are correlated with the cap rates. And very interesting question. We're trying to get our head around that one. So now we're going down from the 10,000 feet flight, and we need an instrument because I want to fly with you now into the markets, into the meter, as I said, that they're different. And what we do at GLL, I developed that in 2012, is a kite analysis. Some of you know it. I like to reduce complexity. The world is so complex. So I said, let's look what drives performance of the real estate, what increases rents and increases prices. And I found 5 categories which I think are very fundamental for your performance in the real estate market, which is liquidity. Sure, what are liquidity? What's capital doing? Transaction volumes, it's leasing potential, it's economic stability, because I think that growth is very important because it translates into take up and rental growth. It's stability of returns, that means how volatile are the markets, and it is price attractiveness. How good is it in the moment to get in or out of the market? The darker green, the more relaxed, the better. The whiter, the worse it is. So just to get a bit familiar with that flying instrument, I took now an example, which is a bit unfair. I have to see, I'm comparing Austin with Detroit. But actually that makes it quite clear. If you look now at that format, that is actually a nice kite. It would fly. This kite from Detroit is very difficult to fly. The components, liquidity, Austin actually was a 500 million trading market in 2011, and now it's traded by $2.5 billion a year, so average is 1.5 billion. Detroit is still there, 500 million. So you see the difference about the scores, it's quite easy. Leasing potential, this very dynamic. Austin had the best score for some years doing this. From 4.5, it comes down to 4, but still we have a leasing ratio here. How many months would take to lease up your vacant space? It is 1 year, so it's below 1 year. Make a comparison, we do that for 150 markets in Rome, it would take you 5 years. So compare 0.8 years with 5 years, and you understand the dynamics at one glance. In Detroit, it takes you 2.5 years yet. So economic stability, we touched that a bit later, but Austin is one of the most growing on a state level and a metro level, most growing metros in the United States, but it's volatile. So for an investor, it's quite easy, this instrument. You can argue with me, yeah, should I enter? I say you can, but you have to watch out. It's very volatile. There's movement at the market. Detroit, more manufacturing based, it is not. At the end, is it attractive to enter? It was. Actually now, things are becoming very pricey. If you look at the cap rates, but more important than that, rental growth is coming down from a 5%, 6%. We had 7% rental growth in Austin last 3 years, and now the projections are about 2.5%. Would I still invest? Yes, because I believe that this is becoming a resilient city. We're doing these for a lot of metros, and what comes down now, after all these years, is that we see a certain pattern. And it comes out that it's all T related, so I call it the 6 T's. What are the T's? Actually, here you see some of them. We have a lot of talents. 25% of the population in Austin is between 20 and 34 years. Young people going to the university, they stay there because they like the life quality and the culture of the city, which is the second T. This is top life quality. Actually, they're all tech-related and techies. I believe in technology. I don't think that we will have a next tech bubble. Technology will change everything. All industry will be affected, so you need these talents. Then we have taxes, so it's easy to do business. Texas, we are in Texas, and actually affordability for the people living there. That's a problem with San Francisco, we'll see in a second. So these are some T's which I touch. There's another T which here is absolutely not present, which is transportation. Transportation is a problem in Austin. Now let me see what that means. If we do this rating all over the US, this is the economic stability now. We could do that for all the scores we're doing. You see clearly the colors, and you know that it's a smiling face of the US. And I took now four cases for showing you that we believe in smart secondaries, which are here, Denver and Austin, but also on resilient primary major markets, which are represented by Boston and San Francisco. If you look at the economy of Boston, you know that it is based on medicine and education, med and ed, and we like that very much because it's stability and resilience. But it is worldwide leading in biotechnology. So biotechnology brought a 3% job growth, which is double average of the US the last year. So it is tech. It is excellent from transportation. However, it's on the Acela corridor where you get to 5 metropolitan regions in 5 hours. It ticks all these T boxes. San Francisco, on the other side, is the epicenter of recovery. In San Francisco, you have an unemployment of 3.4, in some submarkets 2.4. That's rather thin. That is full occupation. Again, technology. So the Nasdaq companies are based there. Google, Yelp, and Facebook, the big three, they made 25% in revenue increase for advertisement in the first half year to 17. They will double down. So again, I believe in technology. Denver stands D for diversity. So here I like something which I saw in Orange County, which is not here. The workforce, the talents are here, and they are flexible. When the oil prices went down, 4,000 people lost their jobs, but they're all working now. They're working in renewable energy, and again in healthcare. And what I find very interesting, the combination of healthcare and big data. Catalyst is one of these companies which has took a bigger leasing, and Austin, we talked about it. Is this translated into real estate data? Yes, 1-to-1. These are the kites. So you see, these are the best kites we have, and again, they're all related to tech. Let me talk about overview real estate market, what happens here. Here we're looking at what is construction doing. Yes, construction is kicking in, but we had the last years 600 to 700 bips in decrease of vacancy rate in these markets. San Francisco had double-digit rates of rental growth 4 years in a row, averaging 14% at each year. Boston had a bit less. Austin, we had 3 times 7% in the last year. But what's happening? Construction is coming. We will see 180,000 now under completion this year, maybe 80 million square feet to be built. It will be absorbed, but it is partly concentrated on some metros. So San Francisco, for instance, will have 10 million square meters to be built right now, the next 3 years, of which CoStar, these are CoStar data, 4 to 5 billion will be absorbed. What does it mean? Vacancy rate will go up. Is it dramatic? No. If take-up is there, we're still in the equilibrium of a vacancy rate, but we have to watch out. At least what we did for today is that I took all my kites and data, tons of data, again a T, and we put it in, and we wanted just to show you who are the winners in my T theory. And if you take the thriving economy, that is Boston. So we have different data sources. I love the US because it's a very transparent market, so you have access. So it's not only consensus data, but we're using different sources here. For that one, we looked at the 2017 state new economy index from ITIF. So I'm interested in economy, but economy driven by digitalization. And there you see Boston. The large talent pool is Austin. Number 3 would be Washington. Would we skip Washington? No, we wouldn't. It's only that I don't have enough time to talk about Washington, but certainly it's a late recovery market, together with Atlanta, which coming quite late now to the party. Tech expertise, it's San Francisco, but number 3 is New York. So excellent transportation. There we're looking at congestion studies, and Salt Lake City is the winner. Salt Lake City came up quite early when I did that. And I talked to my chief investment officer and said, why are my data telling me Salt Lake City? So you have to know we have 3 offices. It's not marketing, only to be honest, where I get the validation of what I'm saying here. We have 3 offices in the US, and I'm discussing all my results with the people on the ground, and they can confirm it. And they immediately flew into Salt Lake City and tried to source deals, which actually was very difficult. Yes, it's booming. It's very good. Life quality is very high. Would love to have it. But it's very difficult to buy product. Top quality of life, Denver again, but here we would see also Raleigh. And if you hear all these markets, maybe they're all on the list for the new Amazon headquarter. Maybe it's a coincidence, I don't know. I had, before the news came out about what the criteria of Amazon as we had these T's. And finally, tax breaks. We have, after me, a speaker, but talking about the tax, so looking forward to it. You have that in your, I've skipped this, 2 words only on retail and logistics. I know that we have excellent presentation about these ones. So if you look only at the data, retail, yes, it is a tight market, 4.6 vacancy rate is not alarming, but I think there is a polarization going up. We talked about e-commerce. I think technology as an overarching trend is changing all property sectors. Think about it. So when we talk about flexibility and the phenomena of co-working, why is that coming up right now? I have the idea that maybe we will have more small businesses in the future, and they need that kind of space. This is true. We're digging into the data, and actually we're seeing that the small businesses are really increasing. That has to do with digital connectivity. So in retail, yeah, we know it, e-commerce, but not only e-commerce, it's also where the malls has been played. The malls that died or dying. They are in secondary cities, and the middle class income has changed, so they're suffering from different types. But I think there are opportunities coming up because both retailers, e-commerce retailers and the brick and mortar retailers, they're learning from each other and they're combining things to omni-channel. But you will hear more about it. I'm looking forward. Logistics, yeah, I said it. It's a winner. It's incredible. Maybe we misjudged that some years ago. We had to go more into logistics. I'm a valuer. I'm coming from a bank, so I'm a risk-trained person. And for us, logistic was a shed with a roof and quite dangerous and risky, and we didn't love to finance it. It's completely changed because actually e-commerce here is a win-win situation. They're not disrupting. There is an additional demand coming from. So yes, increasing rents. Let me come to an end and sum up. Yeah, I took also the speed from my father, sorry. We're going supersonic. But I'm so afraid the bread comes up.
Make you nervous, I'm sorry about
that. No, I'm joking. The US investment market, yeah, we see a modest decline. We heard that and we will hear that more often. Leasing markets, net absorption, they hold up well. So do additions. Yes, there are completions coming, but they are spread. They're not everywhere. They're not spread, but they're concentrated on some metropolitan regions. Vacancy slowly on their way up, and rental growth down a gear, a part of logistics again. The opportunities. I think that even if a downturn comes or a slowdown, the US is a very good place to invest because what we've seen in the last cycles, there are really opportunities of flexibility and to react on challenges. That's a bit different between our continent, Europe, and the US. So they manage problems, they face it, and if you have the right requirements and the substances there, I think that will work out. So we follow the metropolitan regions, and that's not only primary, but also secondary markets, if they fulfill our sixth theorem, I would say, so that you have a thriving economy based on the new economy. Talents, yeah, they have to be there. Technology, transportation, very important. Top quality of life becomes more important, and taxes will lead the way. So I had a discussion recently with an investor because I found the word flexibility so valuable and so important because it shows what happened. But actually,
some of the investors, and I understand it, becomes a little bit tired hearing these new buzzwords, flexibility and efficiency, but I still stick to it because it's what expresses actually what's going on. We're living in an age of transformation where you need flexibility. You don't know how many square meters you need if you're working for a fintech or a fintech working next to your bank building. So companies need to breathe, and actually they want shorter leases. This is all due to the fact that there is transformation going on. Experience and convenience, that would be my two words for the retail sector. And in the logistics, we see that all is about velocity, and we're seeing hybrid formats coming up. I think good old friends or new kids on the block, I think, yes, partly they're new because it's a response to the technology change. You will actually hear today also that talent retention is very important, and architecture and concept is doing a lot about it. It's very expensive. I will finish my little speech about the US economy market showing an example how that could be a little bit less expensive.